Welcome everybody to the Texas REIAs. For those of you that just got here, this is the largest by far network of real estate investor associations in the great state of Texas, with chapters in Austin, Dallas, Houston, and San Antonio. Since 2003, we've had over 100,000 members, participants, and attendees sit in the same chairs you're sitting in. And we have lots and lots of investors all over Texas doing all kinds of things: residential, commercial, active, passive, etc. And we provide resources to the community, to people interested in real estate investing. Great time and place to find money. We offer free training to the community, have power teams, resources, investors. We just put lots of people together in big networks, and they do stuff with each other in ways to make money. And one of the resources that we offer to the community is we provide market information, including market updates. And that's going to be the first topic for tonight's presentation. I'm going to do a market update of what's going on in the Texas real estate market. So in general, what's the big story with real estate? Interest rates, they have changed. So what do you think? Are interest rates high or interest rates low? What do you think? High? Who thinks interest rates are high? Raise your hand if you think interest rates are high. Who thinks interest rates are low? Okay, yeah, mostly high here. Well, in 1981, do you know what interest rates were on mortgages? 18%, close, 18%. If you've been investing since 1981 and you looked at this market, you'd say, wow, interest rates are really cheap. Now, if you were investing 4 years ago, 3 years ago, 2 years ago, and you're looking at the interest rates, you're thinking, wow, interest rates are high. It's just perspective. Now, I started investing in real estate in 2003, and I tell you, I've been buying and I have a big portfolio of rental properties. Most of my rental properties I bought 20 years ago have 6.5%, 7.5% mortgages. That's just normal. My perspective as a full cycle investor is that interest rates are normal. This is normal. 4, 5, 3% mortgage interest rates, that's not normal, folks. That's freakishly, like once in 3 lifetimes, abnormal. I seriously doubt, and who knows, right? Nobody knows what the future will hold. But I think there's a very high probability you will never see that again in the rest of your life and in your children's life. Okay, that was just, you've never seen it before. Not in my lifetime. I go back 50 years and you've never seen anything like that before. So we had a brief period of freakishly, strangely, once in 3 generation, weirdly low interest rates. Now, who knows what's going to happen? I don't know. I mean, nobody knows what's going to happen in the future. But, printing money and deficits and inflation go with higher interest rates, not lower interest rates now. Maybe our government will get fiscally responsible. Who thinks that's going to happen? Bueller? Yeah, I don't know. Could happen. Anything can happen. Anything's possible. And we don't know. But it's perspective. My perspective is interest rates are normal. And I'm actually kind of glad they're normal. It's when things are abnormal, we've had an abnormal market for the last few years. And when things are really abnormal, it's, in my opinion, it's dangerous to invest in an abnormal market. There's just things that are like abnormal, right? It's like, some of you were talking about commercial investing. Man, I think if you got into commercial investing 3 years ago, you're probably sorry. If you're investing in commercial right now, I think it's the perfect time to get it started right now, right? And because we're in a normal market, normal interest rates, normal buyer sellers, things are very normal right now, and I like that. But interest rates have certainly changed, no question about it. And when interest rates go up, what happens to home prices? They go down? They're supposed to go down. Who thinks when interest rates go up, home prices go down? Who thinks they go down? Okay, who thinks when interest rates go up, home prices go up? Who thinks they go up? Okay, nobody's voting here, so let's get a little audience participation here. Who thinks interest rates up make house prices go up? Who thinks interest rates up make house prices go down? We got about 50-50. I would say it does that. It does both. You're both right. You're all right. When interest rates go up, it has both upward and downward pressure on real estate. There's things that push it up, there's things that push it down. I mean, here's the thing about real estate that's more important than anything else. Real estate doesn't really care about interest rates. Real estate doesn't really care about the economy. Real estate cares about supply and demand. It's all about supply and demand. Now, in as much as the economy or interest rates affect supply and demand, yeah, that may affect real estate prices. But it's the purest market there is, supply and demand. So, like in 2008, what happened in 2008? Right, 2002, 3, 4, 5, 6, 7, we had subprime lending. Remember that? If you wanted a loan, you went into a bank, they held a mirror under your nose. If they saw fog, you got a loan, right? That was the loan application process back in 2005. And we just built houses as far as the eye could see. I mean, we never had so many houses, new houses built than in those years before 2008. And so we built bazillions of houses. And we got them all sold. And the way we sold them all is we gave anybody a loan. Man, if you walked into the bank, you could fog a mirror, you got a loan. So we built bazillions of houses, and we gave everybody money, whether they had job credit income or whatever, and we sold all those bazillions of houses. And then in 2008, what happened? The banks went bankrupt. You know, the government actually changed the definition of bankruptcy in 2008, all that mark-to-market stuff. By any real definition, the banks went bankrupt. They stopped lending. Lending just, boom, hit a wall, right? It didn't slow down, it just, boom, hit a wall, right? So all of a sudden, you had all this supply, and demand just hit a wall. And then what happened to real estate? Crashed, right? Crashed. Now, let's take a look at where we are now. Now, money got cheap. Interest rates got cheap, right? Freakishly cheap, but it never got easy. It got cheap, but it didn't get easy. Because after the banks learned their hard lessons, right, when the crash happened, it never got easy to borrow money again. Now, if you want to get a loan these days, what do you have to do to get a loan? Turn over your firstborn, fill out a 1,900-page application, submit blood samples. There's a lot, right, you got to do. And it's a lot harder to borrow money, right? Even though the money got cheap, it still never got easy. So, yeah, we're building more houses, right? But because it never got easy, we're actually not building enough houses. In fact, on a national basis, we are in the middle of a housing shortage. Who's heard that we're in the housing shortage? Yeah. Nationally, they say we have about a 6 million house deficit. We need about 6 million more houses that are available to buy, new houses, than the market demands. And when you have a shortage, when you have a housing shortage, what does that do to prices? Pushes them up, right? There's not enough supply, right? That pushes prices up. But at the same time, interest rates went up. And when interest rates went up, right, their houses are not as affordable. So instead of this many people that can afford to pay a mortgage, now there's only this many people that can afford to pay a mortgage, right? So the demand has gone down, right? So we got this pushing prices up and we got this pushing prices down. And then when you put all that stuff in a blender and push the button and see what is the result? The result is the market is flat. And it is flat as a pancake. It's barely gone up, it's barely gone down. And that's where we are today. And we'll dive into some details in the different cities. But if you look at Texas, the average price home in Texas is actually up a little bit, 2%, 1.8%, actually up a little. The year-to-date price, this is year-to-date price is down 0.2%. So it's flat. It's about as flat as it could be. Now the volume is down. What is the volume? The number of houses, the number of buyers, and number of sellers is down. That's true. So there's less buyers and sellers, but prices are flat as a pancake. And they're really not going anywhere. And we'll talk about that. And by the way, I'm not with the National Association of Realtors. I'm not standing up here with some kind of a motivation of trying to persuade you the market's going up or down. I don't care. I mean, I do care, but I mean, we're not selling anything or offering a subscription or investment opportunity, or we're not trying to do something that we would want you to think the market is going up or the market is going down. We have strategies that make money in up markets. We got strategies that make money in down markets. So I love them all. Frankly, I like the down markets a little better than the up markets because sometimes it's easy to buy and hard to sell. Sometimes it's easy to sell and hard to buy. It's never easy to buy and easy to sell. But I like it when it's a little easier to buy, right? When the market's kind of softening or going down. And I prefer that. It speeds up the velocity of money as a real estate investor. But right now the market is flat. Pretty much as flat as a pancake. Now the mix has changed. Let's talk about the mix. Normally, when it comes to houses, usually 2/3 of the houses that you see for sale are resale houses, and about 1/3 of the houses you see for sale are new construction. But right now, it's the opposite. The mix has switched. 2/3 of the houses that are selling are new construction, and only 1/3 are resale. Why? Because everybody that has a house probably got it refinanced in the last several years at 2, 3, 4, 5%. And they know that if they sell their house and buy a new house, they're going to get a mortgage at 7 or whatever percent. So nobody wants to sell. And because nobody wants to sell, there's a tremendous amount of supply being held off the market, right? Which is another one of those upward forces. Not enough supply for the demand that pushes prices up. Now, the other thing that's happening is money is getting harder and more expensive to get. And because money is getting harder and more expensive, all the builders who've been building all those houses, building is slowing down, right? And at some point, we're going to run out of inventory, right? 2/3 of the houses being sold are new construction, but if you're not doing any new construction, eventually you're going to sell all the new construction, so there's not going to be any new construction being put on the market. There's not going to be any resale houses being put on the market. And then what happens? And then you have more demand than there is supply, right? And that's another thing that can push prices up. So these are all things that are going on in the mix. Now, each city is a little bit different, so we'll also walk through the cities, but I'll start with kind of the statewide numbers. The average price house in the state of Texas is $411,000. It's actually up a little bit, 1.8%, which is kind of interesting. The median price home is $333,000. It's down a little bit, down 0.6. Now, this is the number I always think is like one of the most important numbers. This is the one I look at, months of inventory. What is months of inventory? There's a couple of ways to think about that number. But one way to think about it is that if we just stopped adding any new houses to the market, okay, we're not going to put any more houses for sale. Whatever's for sale, we'll sell that, and then nothing more is going to get added. How long would it last? And that's months of inventory. And right now we have 3.8 months of inventory. If we just stopped adding any new houses for sale in 3.8 months, every house would be gone. There'd be nothing left to buy. Now, to put that into perspective, let's put it in perspective. They say if there's less than 6 months of inventory, you have a seller's market. If there's more than 6 months of inventory, you have a buyer's market. If there's somewhere around 6 months of inventory, you would have a neutral market. We still have a pretty good seller's market. Now, it's not as strong as it was a year ago by any means. Last year is 2.9 months of inventory, so an even stronger seller's market. But by any measure, you still have a pretty good seller's market. So we're not in a buyer's market. We're actually in a seller's market. Now, average days on market has gone up a little bit, but not a whole lot. It takes a little longer to sell a house. Months of inventory is also the average amount of time it takes to sell a house, so it has gone up. Total listings, there's more houses available than there was before. That's why you have more inventory. More months of inventory, because right now there's 100,000 houses for sale, 103, versus last year you had 92,000 houses for sale. Pending sales, it's changed, but not much, right? It's actually pretty similar to what it was a year ago. Now, going back 3 years, again, perspective. 2021, the average price house in the state of Texas went up 18% in 1 year. We had a big year in 2021. 2022 went up another 10.7, almost another 11%. And 2023, year to date, down 0.2%. So, perspective. If you bought a house 3 years ago, your house is worth 30% more than it was 2 years ago, 2 or 3 years ago. Good for you, right? You're a lot richer than you were before. If you bought a house a year ago, you haven't really made any money, right? You haven't made any money, or at least not yet. So it's just perspective. Now, close to ask, that's an interesting number. Right now, the average house is selling for 94, 95% of the asking price. They usually ask a little more than maybe it's worth or maybe even appraised for, and it's selling for a little less than that. Now, in the hot market, the close to ask was closer to 100%, or even there were a few months where it was even higher. Okay, let's dive into some of the different cities, starting with Dallas-Fort Worth. The average price house in Dallas-Fort Worth, $487. Up 3%. Now, let me tell you something about Dallas. Dallas is very interesting. I don't know why this is. I have no idea why this is, but Dallas has always been, we've been tracking this for 20 years, Dallas has always been the bellwether of Texas. I have no idea why. But if you want to know what's going to happen in Houston, San Antonio, and Austin, you look at Dallas. I don't know why, but it's always been several months ahead of all the other markets. And again, I have no idea why, some mix of something. Dallas has taken a little turn in the upward direction. We'll talk about that with the month's inventory too. Median price down a little bit, 1%, 398. Months of inventory, it's doing better than the state. 3 months of inventory, pretty strong market in Dallas. Now, the rest of the state, I mean, last year was 2.5, so it's not as strong as it was, but it's still pretty strong. Active listings is up, but it's only up 7%, right? So not a lot of change there. Now, going back 3 years, 2021, Dallas went up 20% in 1 year. In 1 year, 20%. 2022 went up another 15%. And then 2023, flat. So depending on your perspective, right, you bought a house 3 years ago in Dallas, you're doing really well, right? If you bought it in the last year, you haven't made any money, at least not yet. Now, leases are up a little bit. That's a little bullet worth looking at here because houses are a little less affordable. More people are renting instead of buying because that's all they can maybe afford to do. Lease prices, a lot of inventories come on the market in multifamily. But despite all that inventory and the market being softer, lease prices are still up about 1%. They haven't been getting the big raises they were for the last few years, but they're still up actually, which is way better than down if you own a multifamily. Houston, here we are in the great state of Houston. Houston's, I think, second most affordable major city in Texas. Average price $404, up a little, 0.4, pretty good. Median price $327, down 1%. Months of inventory looks more like the state, 3.6, still decent, pretty decent seller's market. Not as good as it was a year ago, but this is actually trending lower, interestingly enough. Active listings is up a little bit. Houston, 2021 is up 16% in 1 year. 2022 up another 10%. 2023 it is flat. New listings is up. More listings, more people leasing versus buying. Lease prices are up. Not as much supply came onto the market in Houston, so prices are up higher. And some people are saying, is the market soft? Is the market dead? Is the market dying? No, we're in a seller's market and prices are going up. On the rental side, there are a little more inventory, though, available on the market, just like with the residential. Austin, let us talk about Austin, Texas. The average price, this is not a typographical error, of a house in Austin, Texas is $559,000. That is not a typographical error. And we did a little research to try to understand this better, like where did this come from? Where did Austin come from? And it turns out the name Austin is actually Latin for San Francisco. Yeah. Elon Musk, you got it. Silicon Hills is the new name for Austin. And Elon Musk moved to Tesla, and a whole bunch of people followed him in all kinds of high-tech industries. High-tech engineers tend to make six-figure incomes. So people were moving into Austin like crazy over the last several years. In fact, in 2021, sales prices in Austin in 1 year went up to 29%, almost 30% in a single year. And I was there because most of my rental properties are in Austin, Texas. And I got to tell you, 2021 was the craziest market I have ever seen because there were months in Austin, there were months of the market where there was 0.4 months of inventory, 0.4 months of inventory. We literally had less than 2 weeks of inventory. It was crazy. Somebody would put a house on the market in Austin, they'd get 11 offers in a day. And 10 of the people were said, no thank you, and 1 got the deal. And so the 10 guys that didn't get the deal, they'd make an offer on another property, and they'd get 11 offers in a day. And one of them was the winner, and 10 of them were the losers. So after losing 2 or 3 deals in a row, what the buyers started doing is screaming at the realtors, what are you going to do to buy a house? I'm moving here. I need a place to live. Just give them whatever they want. And literally, people were buying houses for 10% above the asking price, right? And that's why you saw that kind of crazy one-year run-up. And the houses weren't even appraising. And if a house does not appraise for the sales price, you have to bring extra money to the table when you close, because the lender will only loan down payment and loan up to the appraised value, right? So the houses were selling above appraised value for frankly more than they were worth. And because of all of that, the market went crazy and went up almost 30% in a single year. The next year, a little better, only up 10%. And then in 2023, Austin is the one market that's had a correction. Sales prices are down 9%. Now, to put this in perspective, if you invested in real estate in Austin 3 years ago, you made the exact same amount of money as if you did in Dallas or Houston, right? But in Austin, it went up 40 and came down 10, right? In the other cities, it just went up 30. What's the difference, right? If it went up 40 and came down 10 or just went up 30, it's the same either way, depending, obviously, on when you got in, right? If you got into Austin the last year, you lost a little money. If you got in 3 years ago, you made a lot of money, and that's perspective. Months of inventory looks kind of like Texas, 3.9. Now, I will say the other thing that happened in Austin is when prices went crazy, everybody started building everything they possibly could, both single family and multifamily, so a lot of supply got dumped onto the market. That's finally starting to slow down, but that yielded a correction. And Austin is the only major city where you saw a correction, but again, depending on where you got in and where you got out, that would kind of determine your correction. Active versus pending is actually leveled off, right? So there used to be a lot more active, new versus a year ago. Now it's about the same, a little higher, but not a whole lot. Closed sales up, actually up versus a year ago. So that's a turn in the market here in Austin. And then finally, San Antonio. San Antonio is the most affordable major city in Texas, $379. Average price house in San Antonio flat, and the median house price $319 is also flat. A little more inventory in San Antonio, 4.4 months. Closed sales is actually down a little bit. San Antonio is the most affordable market. Didn't get the biggest run up, 16% in 2021, 12% more in 2022, and 2023 it's basically flat or technically down 1%, and lease prices are actually down 1%. So that's San Antonio. But pretty much all of that is pretty much flat, depending on your perspective. So what's going to happen next? Nobody knows. And if somebody tells you, like the National Association of Realtors, they always tell you, no matter what's going on in the market, what's going to happen next year? It's going to go up every year. I mean, it's like for 100 years, no matter what's going on in the market. So what do we think is going to happen to the market? I have no idea. And if somebody tells you, here's what's going to happen, they're saying, okay, I have a magical crystal ball that can tell the future. Our best guess about what's going to happen is nothing's going to happen. I don't really expect prices to go up much or to go down much. I don't really see anything happening. Now, all bets are off, right? A war, a nuclear bomb, another pandemic. I mean, who knows, right? I mean, barring some unpredictable thing, there's really not anything likely to happen. I will say, if I'm really going to bet, I'm going to bet interest rates will probably start coming down a little bit. That's what most people would say. We probably have peaked on the interest rates. The Fed has kind of slowed down raising the rates. They may go one more, but probably not, right? We're probably going to get this mysterious soft landing that everybody talks about, and this may be the first time we actually get one. And most of the smart money would say interest rates are probably going to go down a little bit, but I wouldn't expect them to go down a lot. I would expect them to go down just a little bit. Now, if interest rates go down, what happens to home prices? More demand, right? And at the same time, we have slowed down building. And that inventory of, which is 2/3 of the inventory of new construction, is starting to slow down, right? We're not building as much. We're still building a lot, but not as much. And people keep having babies and keep moving to Texas. So if you look at all of those factors, barring some other factor, that's probably going to push prices up a little bit in the next year. But I wouldn't expect them to be up a whole lot. So any questions or comments on any of this? Was this helpful, folks? Yeah? Any questions on this? Go ahead. Oh, I'm sorry, what's that? So all of this data is public. A lot of this we pull from the Texas A&M School of Real Estate, so it's a great online resource. But I'll also say an even better resource is just follow Texas REIAs on Facebook, Instagram, or YouTube, because we also publish all of these slides on our social media. So if you just follow our social media, you can see all this stuff anytime you want. So yeah, and just checking in from time to time, we have these nice little slides that are pretty infographic friendly, so you can get a pretty good snapshot at any time by just kind of checking on the website and seeing where things are. Question? Yeah. I mean, prices went up. They came down, and then they kind of leveled off. I think this is just where we are for a while. I think Austin went like that. All the other markets went like that. But they're both up 30% in 3 years. So, it's just how the curve shaped. People are not buying houses for 10% more than they're worth. Now there's plenty of inventory available in Austin, but not a lot. I mean, it's still a seller's market, even in Austin. So, question? I held. So I have never tried to time a market. I don't think I'm smart enough. I don't believe anybody's smart enough. Honestly, most of my portfolio I've owned for 20 years. I just buy. My rental properties don't generate a whole lot of cash flow. Anybody that tells you that rental properties generate lots of cash flow, I think that's a lie, or at least an exaggeration. Anytime you own rental property, I own a lot of, I got about a $30 million portfolio. And when somebody tells me they're getting all this cash flow, I'm always like, yeah, tell me about your cash flow. Because even if you're getting $500 a month, right, which is if you have any kind of loan, unless you're buying for cash, right, what happens, right? You're making money, boom, new roof, $8,000. You just wiped out a year's worth of cash flow. And then you get ahead again, making money, boom, new air conditioner, $9,500, right? And then you catch up, you're making money, boom, make ready, right? Another $8,500, right? And so it's just the real, after depreciation, property management, make readies, maintenance. I mean, there's not a tremendous amount of cash flow. There's some. I mean, I'm not saying there's none, but the beauty, in my opinion, of rental properties is just the wealth, right? So, because I now own $30 million worth of houses, the total debt on my portfolio is less than $5 million. Why? Because over 20 years, the property doubled, and they doubled again. Some of them double a third time, okay, while the tenants paid off the mortgages. And I just let them ride. I do other things to make money, so I don't really rely on the rental portfolio to make me money, but it's made me wealthy. If I ever wanted to retire, and I don't have a plan to retire, but if I ever want to retire, it's not going to be from cash flow, it's going to be selling properties, right? Because you can sit on a beach and drink a lot of margaritas for a long time with $25 million of equity. So to me, rental properties is a wealth building strategy. It's a nest egg. It could be a retirement plan if you want to retire. Okay. Other questions or comments?